Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending January 17th, 2025. Appreciate you all tuning in, liking, and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I am titling the video, Are Markets Refreshed and Ready to Break Out After the Inauguration? And that's a big question here. We've had a rally this week. You see all the green. This is over the last week, S&P 500. Apple really the big loser here, along with Eli Lilly, United Health, Intuit down here. Even Nvidia, though, only flat on the week. But you can see a lot of green elsewhere. And even the Mag 7, a lot of them are up. Broadcom, it's Google, et cetera, but not a lot, or especially compared to financials, right? Wells Fargo up 9%, Berkshire up 3, JP Morgan 7, Blackstone 5, and you look down into the industrials, there's a lot of strength there. The only really Mag 7 that did well this week was Tesla, especially compared to a lot of the other, big uh, industrial names, utility names, chemical names, finance names, etc. So pretty interesting, broad breadth, actually. So this is positive. This is what you see when, the rest of the market is holding its own. Last year was very Mag 7 driven with returns. If you didn't own the top, 8, 10 names, performers in the index, you had trouble keeping up with the index, right? And so this year, I think it's going to be very different. I think it's going to be the rest of the market that's going to have to hold the water for the markets. And you can easily see, I think the Mag 7 have much less returns. Let's just say that. Maybe it's negative in some instances. Actually, almost assuredly, one of the Mag 7 names is going to have negative returns for this year. It's just a matter of which one, how many, etc. So that's the this week in markets. I'll get into the charts in a bit, but let's go over the economic data. You did have a lot of inflation prints. You had PPI that came in down a little bit. Core PPI was down almost flat month over month. So that was probably the biggest positive on the inflation front. The CPI did come in a bit hotter, except for the core that came in a bit cooler month over month. And then on the jobs front, continuous claims did tick down, even though new claims that actually ticked up. I'll show you where that is. Initial claims. There we go. This is initial claims. Let's go to a 1 year. That did tick up, but from a low level, right? So I like to follow continuous claims, and overall, the jobs market, it's kind of back to trend. It's not terrible, it's not great, and a lot will, certainly depend on this new administration and its policies, and we'll talk about that in a second. Import prices that did accelerate to 2.25% year over year. Export prices nearly 2%. So, this will feed into CPI. So I do think you could see inflation accelerate probably more in the second and third quarter, not necessarily the first quarter. There's a lot of shelter inflation or disinflation that's yet to feed into the CPI prints, and that'll probably happen in the first quarter. But I could easily see inflation reaccelerating into the back half of the year. So be on the lookout for that. Housing starts up to 1.5 million, the highest level since February. Let's zoom out here. And you can see, looks like housing starts are starting to bottom despite mortgage rates, around 7%. Industrial production did accelerate as well month over month. So that was a nice move there. And you're starting to see the manufacturing side, not the biggest part of our economy, but an important part of our economy. So that's starting to do fairly well. You have surplus. Oh, this is what I get to: surplus and deficit. So I've talked about this before, and government spending is a big part of GDP. And going into the back half of this year, September actually we had a surplus. Okay, now a lot of that is uh, taxes being spent by corporations, tax deadline. But you see October, November, it blew out once again. And this is, whether you like it or not, in the near term, positive for GDP. Okay. So what Trump does with the deficit and Doge, right, is going to be very vital, especially in the near term, to see, are they crimping spending dramatically, and is that going to feed into broader liquidity and the economy? Okay. And then commercial bank credit. Okay, this is up to 3.65% year over year. This is headed higher. Okay, that is a positive. Okay, you go back to previous periods when there was a recession, right? And you see this in deeply negative territory. So I've showed this before, and that is positive for the economy as a whole. Now on the Fed front, now this is this is the rate expectations. Now I do think this is going to be less important this year because I think they're going to pause for an extended period of time, kind of see what happens with the new administration. Probably going to need 3 to 6 months of policy impact on and just sentiment impact with this new administration to see kind of where inflation and the economy goes. So I think they're going to be on pause for a while, and that's what the market is kind of saying, right? They're saying that not really until June where they see potential policy moves, and they're still expecting it to the downside, right? You said May. May, it's still better 50% chance that it's where it's at now. So June, July, summer time frame, but a lot can happen in 6 months. So that's just what the market has priced in right now. But this is kind of a sideshow to the broader QT discussion. The balance sheet of the Fed, are they increasing the balance sheet? Are they reducing the balance sheet? That is a big question mark here, and what I will be watching more than what rates will be. Okay, so something to consider. Another reason why I don't think the market is going to break down anytime soon, well, soon is I guess a relative term, but the next, call it 30, 60 days, is Bitcoin. Bitcoin is basically liquidity proxy. Kind of shows you when liquidity is ebbing or strong. And so, I said when this pulled back, I said if Bitcoin breaks 90, then this is a early indicator that this pullback in markets through December and early January is probably going to expand and pull back much more. If this doesn't, if it holds the 90 level, then I think we hang in there. And we kind of tested it right in the low 90s a couple times, 92, 93 in that range, and we've held it. And now we're not breaking out to the new highs, above 106, 107, but still, this recent move in Bitcoin certainly is positive. Now, is this a buy the rumor, sell the news type of event? With the inauguration coming up in a couple of days, obviously Trump is perceived to be pro Bitcoin. What's he gonna do if there is Bitcoin reserve? Are they just holding on to the crypto that they've confiscated over the last few years, et cetera? We'll see. But ultimately, I think that's probably more likely. Remains in a choppy period, kind of similar to where we were, early last year, and into a catalyst, which was, the Trump bump, right, going from 60 all the way to 100. Is this a buy the rumor, sell the news type event? I lean that way versus a breakout in Bitcoin. But if it's chop, that's fine for the broader markets. If it's a break below still that 90 level, I think that is early indicator that the markets will have a broader pullback. Now let's move on to the charts here. Okay, let me pull up the S&P. Actually, let's go to the cash. Here's the S&P. Still remains in a bear flag position. Needs to get above, call it 60 roughly, for the actually 60, 70, it looks like, for the S&P to potentially break out. Now, this choppy period pullback, refresh the 100-day moving average, that can be enough to refresh sentiment and keep the market moving higher. You saw that with the unwind of the yen carry trade back in the summer. We had this big kind of washout, and then we just continued higher. Was this enough? Possibly, especially if liquidity remains relatively robust. I think that's fine. Now, the biggest thing that is going to potentially cause a problem is do rates. Here's the 10-year treasury bond. If this goes down, that means rates are up, vice versa. So you've seen rates move in a big time fashion over the past few months and into support, right? The broader treasury bonds, the 10-year treasury is into support. And you've received a little bounce here on inflation data that isn't too hawkish, isn't too bad. And like I said, I don't expect the inflation data to really get out of hand in the short term. And so I could see a bounce in treasuries. But if you see this roll over back again, right, hit the 50-day like it did here and roll back over, that could be another catalyst for a bit more volatility in markets. Okay, so I'll be watching to that to see what durability this bounce in treasuries has. Ultimately, I think we get one more move lower, and that could spook the market just a bit sometime in the first quarter. Now let's take a look at the Nasdaq. Nasdaq, same kind of bearish pattern, a bit overbought in the short term, but kind of neutral. That's kind of what you have to say with the broad S&P and the Nasdaq. You have is the move index. I'm always consistently watching this as well. This is the volatility of the Treasury market, and the big question here is, does this start to edge up towards 110, 120, 130? In those ranges, that tells you the debt situation and liquidity is becoming more untenable, and I do think that could catalyze the markets into a sell-off, and I could see the dollar getting weaker. And it's something I'll be watching as well, right? The dollar remains strong, and I think that will turn sometime this year. But if that remains strong, that is also certainly a crimp on broader liquidity. Okay. And then here's the transportation index is IYT. So this got a nice bounce, but does it hold, or is this right? If you go to a weekly, this was certainly a strong reversal, right? Broke below, made a lower, could make a lower low here. Could be, look at the MACD kind of weakening. This is a potential red flag, something I'll be watching, and started to show some weakness over the past couple of months. So be on the lookout for that. Junk bonds, let's go back to a daily here. So short-term junk to short-term treasuries. This is fine. This is an indicator. This is not telling you there are any issues on the horizon for the credit markets, and thus any drop in equities is just one to be bought. This is the reflation index, so the ProShares Inflation Expectations ETF. So this is headed higher. This is one of the reasons why rates are going up, and I'll be watching this as well. Does this stay in this kind of choppy pattern? Is this just the high end of the range, or do we get a breakout up into the 34, 35 level, and that would probably push interest rates up? It would make the markets or the Fed a bit more hawkish, and something I'll be watching as well. It did attempt to break out last week, but this week kind of pulled back a little bit, and I'll be on the lookout for that. Let's see, the growth to value trade, that did, you saw value certainly outperform this week overall, and has this topped? We shall see, but I'll be watching for this and this trend line here. Right, there's a pretty good trend line that you can draw right here, and I'll see, is this uptrend going to remain intact over the next couple of months? My hunch, based on where liquidity is, where the Trump administration policies are, I do expect this to roll over, but we shall see. What else do I want to get to? Let's get into gold. Here's gold. Gold remains relatively strong. I talked about this kind of H pattern, pullback, rally, lower high, but then a higher low. That's an H pattern. And if this can break out above, this would be very good for gold prices. It's probably going to need lower rates, probably going to need a bit of a lower dollar. Both of those have been working in the opposite, going in the opposite direction for what gold needs. But nonetheless, gold's hanging in there. And so that relative strength for me is very, very encouraging. You see the miners starting to find some footing here after roughly testing that 618 retrace from this broader move. And so I think this could be refreshed for another move higher. What else do I want to get into? Are there any other topics? Let's look at the commodity index. This is breaking out. So this is also pushing inflation expectations higher. This is really driven by oil and natural gas. Both are finding some strength here, and obviously that's going to feed into inflation data. So you have the housing costs going to push down inflation in the near term, but that's kind of an anomaly, and that's why I think the near-term moves in commodities will certainly have a bigger impact on market sentiment than I think those headline numbers as they come in if you continue to get some traction here in the commodity index. And so, there's one thing to follow the headline numbers, but ultimately we rely more on the market data, and this is a good example. And this is going to give you a more real-time look of what's happening, and how that will feed into the economic data that will come down the pipe here over the next number of months. So, something I continue to be on the watch for. So, overall, kind of neutral in markets. Here's the NYSE, obviously a broader index. This has refreshed down to the 200-day moving average. You made a little higher a low here, and this has moved higher. Is this just a refresh, kind of like the summer, that allows for new highs? Certainly possible. I expect the volatility to pick up more in the back half of the year than the first half of this year. I've said this for a while. Liquidity remains relatively robust. The Treasury is not issuing a ton of longer dated maturities in the first quarter, and that's pulling liquidity out of the market. In general, authorities are broadly accommodative, and that means you have the path of least resistance being higher. Now, could the new Trump administration throw a wrench in it and putting policies that the market doesn't like, and could you have the type of Liz Truss moment that blows out the Treasury market, or do really just crimps the expectations for earnings for corporations going into next year, due to tariffs, due to out of left field policies. We know Trump's a wild card. We don't know what we're going to get. There's a lot of rhetoric, but the facts on the ground will be different than that rhetoric. And so we will be continuing to watch that. But in the near term, you have to kind of expect higher prices for equities, until you get broader signs of the VIX. We'll go to the VIX. VIX breaking out, the MOVE index really breaking out. That's the one I'm kind of watching. Treasury or credit spreads widening out. Those are areas that I'll be watching for signs that pullbacks no longer should be bought. They should be, rallies should be sold. And we're not quite in that market yet. Do we think we get there this year? Yes, I do. But you have to wait to see the whites of the eyes before you, jump ahead of that trend, because you could easily see another 5, 10, 15% run in treasuries, or sorry, in the markets, before you get that ultimate, broader market top, broader pullback. And maybe you don't get that this year, but I do think you get more volatility in the back half of the year. So that's where we're at. Appreciate you all tuning in. Hope you have a wonderful weekend. A reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.